Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, welcome to The Explainer. Today, we're going to pull back the curtain on the system that one of America's most successful stock traders uses to get what he calls superperformance. And let me tell you, this isn't about luck or hot tips. It's about a specific, repeatable blueprint.
Okay, let me ask you something. Have you ever done this? You see a stock that's just been totally beaten down, right? It looks so cheap you think, this has got to be a bargain. So you jump in, feeling pretty smart about it, and then you just watch in horror as it keeps on falling. If you're nodding your head right now, don't worry, you are in very good company. It's a classic trap.
I mean, get this. Mark Minervini, the stock wizard himself, flat out admits that this was his exact strategy when he started. He thought buying stocks near their all-time lows was the secret sauce. You know, it kind of makes sense on the surface, but he found out the hard way that it was a recipe for disaster. It's just a fundamental misunderstanding of how the big winning stocks actually behave.
So what's the fix? But let's dive into the massive breakthrough he had. The real key to superperformance, he discovered, has nothing to do with buying cheap stocks. Nope, it's all about understanding that every single great stock goes through a predictable life cycle, and your job is to figure out what part of that cycle it's in right now. And this right here, this is the absolute core of the whole thing. It means you stop trying to predict the future. You stop trying to guess where the bottom is. Instead, you shift your entire focus to just recognizing a pattern, a four-stage cycle that happens over and over and over again. Once you can see that pattern, you're not guessing anymore. You're not gambling. You're basically just following a rule book.
And wow, check this out. This chart is a perfect illustration of that whole journey. What you're looking at is the biotech company Amgen, and you can see as clear as day the four distinct stages it went through on its way to becoming a massive winner. So let's break down exactly what's going on in each of these phases.
Okay, so everything kicks off right here in what's called stage 1, the neglect phase. This is after a stock has been in a big decline. It just goes flat. It trades sideways in a range, sometimes for months, sometimes even for years. The public has totally forgotten about it. But this is super important. This is when the smart money, the big institutions, might be slowly and quietly buying up shares, building their positions without anyone noticing.
All right, now this is the main event. This is where the magic happens. Stage 2, the advancing phase. This is the healthy, powerful uptrend. The stock finally breaks out of that long stage 1 base and starts making a series of higher highs and higher lows. But here's the real tell. Look at the volume. Those huge spikes in volume on days the price goes up, that's the footprint of the big dogs, the institutions aggressively buying in. This is exactly where you want to be.
But, no party lasts forever. After that awesome run, the stock rolls into stage 3, the topping phase. And the whole feel of the stock just changes. That smooth upward progress is gone. Instead, you get these wild, volatile price swings. You'll see massive trading volume, but the stock isn't actually going anywhere. This is a huge warning sign. It's the institutions now selling or distributing all those shares they bought to the unsuspecting public. And that brings us to the final and most painful phase, stage 4, the declining phase. Once all that institutional selling is done, the floor gives out. The stock breaks down and just enters this punishing downtrend. The path of least resistance is clearly down. Seriously, your number one job as a trader is to make sure you are nowhere near a stock when it's in this phase. So look, if you take away just one thing from all this, let it be this. Your entire strategy, your entire focus should be zeroed in on this one single moment. That transition from the quiet, boring stage 1 into the powerful, explosive stage 2, that is the sweet spot. That's the point of lowest risk and highest potential reward. Everything else is pretty much just noise.
Okay, great. So now we know when to buy. But that just leads to the next big question, right? What do we buy? I mean, there are thousands of stocks out there. Well, the system narrows it all down and tells you to focus on only one type of stock, the market leaders. Let's see how you find them.
Okay, so let's get something straight. A market leader doesn't mean the biggest company or the one with the most famous name. In this system, a leader is defined by one thing and one thing only. It's price performance. These are the stocks that are simply the strongest, the ones outperforming everybody else. And why does that matter? Because when a new bull market starts, these are the stocks that take off first. They climb the fastest and they go up the furthest. You're basically putting the wind at your back.
And this chart, it just proves the point perfectly. That solid line, that's the market leaders. Just look at it. They start moving up before the general market, that dotted line, even knows what's happening. And they just climb so much higher. By following the leaders, you're getting into the strongest stocks before the rest of the crowd even shows up to the party.
So how can you actually spot one of these leaders before everyone else jumps on board? Well, one of the biggest clues is what's called institutional sponsorship. That's just a fancy way of saying the big money, we're talking mutual funds, hedge funds, they're buying the stock in massive amounts, and you can see their footprints all over the chart. They look like these enormous spikes in trading volume on up days, just like you see here with Netflix. That's not your average investor buying. That's the unmistakable sign that institutions are building a huge position, and that can fuel a stock's rise for a long, long time.
Okay, so let's recap. You found a market leader. It's just starting a stage 2 uptrend. We're almost there. The last piece of the puzzle, and maybe the most important, is all about timing. You have to pinpoint the exact moment to get in for the lowest possible risk.
And for this, Minervini has a signature move. It's called the Volatility Contraction Pattern, or VCP for short. The best way to think about it is like a spring coiling tighter and tighter. The stock moves up, pulls back a bit, moves up again, pulls back again, but each pullback is smaller or shallower than the one before it. What this shows is that the sellers are running out of steam, supply is drying up, and that stock is building up a ton of energy for a big move.
And here we go. This is a perfect picture of a VCP in the wild. Look at this chart of American superconductor. You see that initial run-up? Then it pulls back. But then look at the next pullback. It's smaller. And the next one is even smaller than that. The volatility is literally contracting, squeezing tighter and tighter from left to right. That's a textbook sign that all the sellers are gone, and it's setting the stage for a massive breakout.
Right at the tightest point of that squeeze, that's where you find it, the pivot point. Think of it like a starting line in a race. It's a very specific price. When the stock breaks above that pivot point, it's like the starting pistol goes off. It signals that the quiet period is over and the next big move up is starting right now. That's your trigger to buy. Now, once you pull the trigger and buy, you don't want to be sitting around wondering if you made the right call. You want to see confirmation, and you want to see it fast. The very best stocks, the true leaders, show what Minervini calls tennis ball action. It means if there's any little bit of selling, the stock doesn't just fall over. Instead, buyers rush in and it bounces right back, just like a tennis ball dropped on concrete. That tells you you're in a really strong stock with powerful buyers behind it.
All right, so we've got the stages, we know how to spot the leaders, and we have our entry signal. But none of it, works without the right mindset, the right discipline to actually follow the rules. So let's talk about how this all comes together.
Man, this quote really flips the script on how most people think about investing. The goal isn't just to buy low and hope to sell high someday. The goal is to buy a stock at the exact moment it's ready to make a big move higher, right now. You're not buying weakness and hoping it gets better. You're buying proven strength at a precise point in time.
So, let's put it all together. This is the whole blueprint, the step-by-step game plan. Number 1, you make sure the stock is in a solid stage 2 uptrend. 2, you only focus on the absolute strongest market leaders. 3, you have the patience to wait for that low-risk VCP setup to appear. 4, you buy it as it crosses that pivot point. And number 5, and this is probably the most important rule of all, if the trade doesn't work, you cut your loss immediately, no questions asked. It's a system built on protecting yourself first.
And that really leaves us with one last, and maybe the most important question you gotta ask yourself. When you click that buy button, are you doing it because you followed a clear, tested process? Or are you just doing it based on a gut feeling, a story you heard, or just plain old hope that'll go up? The answer to that question, well, that could change everything for you.
So, what does it really take to win? In any high-stakes competition, we all know it's about more than just raw talent, right? It's a game of mindset. Well, today we're diving into a powerful idea, that the stock market is exactly the same. It's a psychological battlefield where champions are made, not just by crunching numbers, but by what's going on inside their heads.
The one and only Muhammad Ali, he nailed it. Champions aren't built with weights and treadmills. No, they're forged from something deeper, that fire in the belly, that desire, that dream he's talking about. And that, right there, is the perfect way to look at what we're about to unpack.
And that's the connection we're making today. Look, a marathon runner needs that relentless endurance. A grandmaster in chess needs to see 10 moves ahead. But a truly winning stock trader, they've got a specific set of mental tools that sets them worlds apart from everyone else. This isn't just about money. It's a battle of discipline, vision, and pure psychology. So let's get into the story of a trader who embodies this. His journey didn't kick off with a fancy degree from an Ivy League school or a big trust fund. Nope. It all started with a powerful call to adventure. This deep, burning need to be free.
It's a pretty wild question, isn't it? I mean, it flies in the face of just about everything we're ever taught. But for the person at the heart of our story today, this wasn't some philosophical debate. It was his reality.
15. That's how old he was when he dropped out of school. He never even stepped foot in a high school classroom, let alone a college lecture hall. He was almost entirely self-taught, driven by this just insatiable hunger to learn everything he could about one thing, the markets. And this part is absolutely crucial. The big prize for him, the end goal, wasn't just a mountain of cash. It was real, personal freedom, the ability to do what he wanted, whenever he wanted, wherever he wanted. The stock market, that was just the tool to get him there. But you know how it goes. That kind of freedom, it doesn't just fall into your lap. His story is not one of those overnight successes you see on social media. Far from it. In fact, his early years were this brutal, painful test of will, just filled with one failure after another.
For 6 straight years, he was in the trenches, studying, trading, trying everything, and he made zero money. In fact, he actually lost money over that whole time. Just think about that for a second. 6 years. Most people would have thrown in the towel way before then.
And you can just imagine the whole time what he was hearing from people. You know, that it's a rigged game, he was just gambling his money away, that the stock market is too risky. This is the exact kind of noise from the outside that just crushes most people's ambitions. But his persistence, it was on another level.
And this right here is the incredible lesson he forged in that fire. There's a huge difference between being interested in something and being truly committed. See, interest is easy. It's what gets you to buy the book or watch the video. But commitment is when you've burned the boats and the only option left is success. That's what gets you through 6 straight years of losses.
So out of that insane commitment and years of just gut-wrenching trial and error, a really unique philosophy started to emerge. This wasn't something he copied from a textbook. This was something he built, piece by painful piece, from his own experience.
Okay, at first glance, that sounds like a complete contradiction, doesn't it? How can you be conservative and aggressive at the same time? But it's actually genius. It means you are absolutely aggressive in hunting down those massive game-changing opportunities. But your first, last, and only thought is always about protecting what you have, about managing that risk so you can live to fight another day.
This is what almost every amateur asks. It's that lottery ticket mindset, you know? All eyes are on the jackpot. But a pro, a real champion of the market, they start from a totally different place. And boom, that one little flip of a question changes the entire game. By asking how much can I lose before anything else, he guaranteed his own survival. Because let's be honest, you can't win if you get knocked out of the game. This risk-first mentality became the foundation of everything he did, and it's what kept him in the fight long enough for his moment to finally come.
And that moment, it definitely came. After all those years of obsessive, fanatical preparation, the stage was finally set. The market started to move, the opportunity of a lifetime appeared, and you better believe he was ready.
I mean, just look at this level of dedication. 70 to 80 hours a week. We're talking about poring over charts until the sun came up, digging into every single mistake, reading more than 1,000 books on investing. He was like an Olympic swimmer who had spent a decade in the pool practicing for one single race. He was prepared.
And then, in the 1990s, a massive bull market took off. It was like the perfect pitch was finally coming right down the middle of the plate. All those years of failure, all those thousands of hours of study, it was all for this. He was ready to swing for the fences.
220%. Let that sink in. That wasn't his total return over the whole period. That was his average annual return from 1994 to 2000, what he was averaging year after year after year.
And the result of that, a compounded total return of over 33,000%. This isn't just a good return. This is what you call superperformance. It's the kind of return that changes everything. And it was all built on a foundation of failure and relentless dedication.
So why share all this? Why give away the secrets that led to that kind of success? Well, because he realized all that hard-won knowledge would just be wasted if he didn't pass it on. It's about passing the torch, you know? just like the legendary traders of the past did for him through their books.
I love this quote because it's the perfect cure for analysis paralysis. So many of us, we wait for the perfect plan, the perfect moment. But the real secret is just to start. Doing something, even imperfectly, is infinitely better than doing nothing, because you only truly learn when you're actually in the arena.
When you boil it all down, it comes to a choice that every single one of us has to make every single day. You can either make excuses, list all the reasons why something won't work, or you can make money. In the stock market, you just can't do both.
And this might be the most profound lesson of the whole story. The real breakthrough didn't come when he was chasing dollars. It came when he shifted his entire focus to mastery, to just falling in love with the craft itself. The superperformance, the money, all of it. That was just a side effect of his singular mission to become the absolute best trader he could possibly be.
So, in the end, this story isn't just about him. It's a blueprint. It's a challenge. He made a conscious decision. Stop making excuses and start pursuing mastery with every fiber of his being. The only question left is, when does your journey begin?
Welcome to The Explainer. Today we are diving into the single most important thing you need to get right if you want to achieve super performance in the stock market. And spoiler alert, it has nothing to do with some secret strategy. We're breaking down the essential mindset from Chapter 2 of Trade Like a Stock Market Wizard. And trust me, this is the psychological foundation that separates the absolute legends from everyone else.
I mean, that's the dream, isn't it? It's the reason most of us get into this in the first place, to get those incredible, life-changing returns. We see the stories, we hear about the huge wins, and we think, hey, why can't that be me? But let's get real for a second. A lot of people hope for it, but very, very few actually pull it off.
And that right there is the harsh reality. If you look at the numbers over the long haul, the average investor isn't just missing out on big gains. They're usually stuck with kind of blah, inconsistent results. Or worse, they're losing money, sometimes their entire account. So what's going on here? What's the big disconnect?
Well, the reason for this massive gap between what people want and what they get, it's not about finding some magic formula or getting access to secret Wall Street info. It's not just about being unlucky either. It comes down to something much, much deeper. It's all about what you believe and what you assume to be true before you even click the buy button.
You know, Henry Ford was a master at shattering what people thought was possible. And this quote fits trading perfectly. He was convinced that every single one of us has this huge well of untapped potential. So if that's true, what is it that's really holding most investors back from what they're truly capable of achieving? Okay, here it is. The core problem is faulty assumptions. Most people trade based on their gut feelings, personal opinions, and emotions. They're not actually studying what has historically created super performance. They've been fed this myth that to get big returns, you have to take these crazy, stomach-turning risks. And so deep down, they just don't believe it's really possible for them.
This quote from the legendary golfer Gary Player, man, it just nails the mindset shift we need to make. Success in any high-performance field, and yes, trading is one of them, is not about getting lucky or rolling the dice. It's a skill. It's the direct result of hard work, dedication, and knowing what you're doing.
Thinking that trading is gambling is one of the biggest mistakes you can make. I mean, think about it. You could call brain surgery a gamble, but to a trained surgeon, it's a precise skill. Well, trading is no different. It's about having a plan, having discipline, and putting the odds in your favor over the long run. Gambling is the total opposite. No plan, all emotion, and the house is literally built to make you lose.
And at the end of the day, it's on you. You have to take complete ownership. Waiting for some hot tip from a guru or hoping your fund manager will make you rich, that's a losing strategy. The road to super performance starts the moment you realize that the biggest fight isn't with the market, it's the one going on right between your own two ears.
Which brings us to what might be the single most important question you will ever face as a trader. Seriously, take a second and think about this. It sounds like this should be the same thing, right? But so often, our desperate need to be right, to protect our ego, is the number one thing that stops us from actually making money.
And this chart just lays out that internal battle perfectly. On the left, you've got ego. That's you holding onto a losing stock because selling it means you have to admit you made a mistake. You're afraid of what people will say, you feel humiliated, you just want to prove you were smart. And on the right, you've got discipline. That's all about making money. Selling losers fast to protect your cash, looking at your mistakes without emotion, and staying laser focused on the only thing that matters, profit. The author learned this the hard way. He actually admitted that he'd hold on to losing stocks just so he wouldn't have to hear his broker say, "I told you so." But then he had his big aha moment. He made a conscious choice. He was going to stop trading to feed his ego and start trading to make money. And the second he started cutting his losses small without feeling ashamed, his performance went from mediocre to absolutely stellar, almost overnight.
Now, let's talk about that other enemy, getting bad advice from so-called experts. The author's first huge mistake is a perfect example. He was new to the game, and his broker pitched him what he called a sure thing. This little biotech company that was supposedly about to get a new AIDS drug approved by the FDA. The story sounded incredible, and the promise of a huge payday totally blinded him to the risk.
So he bought in, and almost immediately, you guessed it, things went south. The stock sold off hard. It dropped from $18 a share all the way down to $12. A little concern turned into full-blown panic, and instead of just cutting his losses, he did what so many new traders do. He called the guy who got him into the mess in the first place.
And what was the broker's advice? Oh, it was the classic trap. This is a gift, a once-in-a-lifetime opportunity. It's on sale now. You got to double down and lower your average cost. This is just throwing good money after bad based on absolutely nothing but hope and someone else's opinion.
The story ends exactly how you'd imagine. He listened to the advice, and the stock just kept sinking and sinking and sinking. In just a few months, he had to watch in horror as his entire account got completely wiped out. The stock fell to less than $1 a share. A brutal, painful lesson. But here's the thing. That total catastrophe was actually the best thing that could have happened to him. It was a favor in disguise, because it forced him to realize something profound. He could never, ever again hand over his financial destiny to someone else. That was the moment he decided to take 100% responsibility, to do his own homework, and to own his results.
And once you decide to take control, you realize something amazing. As an individual, you have a huge advantage over the big guys, the giant funds and institutions. They are so handicapped by their own size. You can jump in and out of a stock in a second. They can't. You have total flexibility to buy anything. They're stuck with an approved list. You can concentrate your money on your very best ideas. They're forced to diversify into hundreds of stocks. And you can make a decision instantly. They have to go get approval from a committee.
The legendary investor Peter Lynch said it best. If you want to get unconventional, super performance level results, you simply cannot follow the conventional wisdom of the crowd or the so-called professionals. You've got to think for yourself and use the unique advantages that you have. So you're ready to do it yourself. You just need to practice, right? Well, hold on. There's a dangerous trap here. See, every single time you do something in the market, whether it's right or wrong, your brain reinforces that action. You're literally wiring it in. And if you repeat it enough, it becomes an automatic habit, even if it's a terrible money-losing habit.
Here's the key takeaway. Practice doesn't make perfect. Practice makes permanent. Just like the legendary football coach Vince Lombardi said, only perfect practice makes perfect. What that means for us is that you have to practice the right principles over and over again, while constantly analyzing your results to get rid of the bad habits, not burn them into your brain.
And Bruce Lee absolutely nails how you should practice. You have to specialize. You can't be a master of value investing and growth investing and swing trading and day trading all at the same time. If you try to master everything, you'll end up mastering nothing. Pick a style that works for you, define your rules, and then practice with relentless focus.
Let's finish up with a really powerful story about belief. For decades, for as long as anyone could remember, the 4-minute mile was seen as an unbreakable barrier. Scientists and doctors literally said the human body was not physically capable of it. And then, on May 6, 1954, a guy named Roger Bannister did it. He ran it in 3:59. Just 46 days later, somebody else ran it even faster. And within 3 years, 16 other runners had also broken the barrier.
So what happened? Was there some sudden leap forward in human evolution in 1954? No, of course not. The only thing that changed was the belief system. Once Roger Bannister proved that the barrier wasn't physical, it was mental. The floodgates just flew open for everybody else. He completely redefined what was possible. And that really brings us to the core lesson of all this. Super performance in the stock market is possible. The biggest barriers we face, the things that really hold us back, they aren't in the charts or the news headlines. They're in our own minds. Believing you can do it, truly believing it, is the first and most important step.
So the only question left to ask is, what records are you ready to go out and break? All right, let's jump right in. If you've ever stared at a stock chart and just wondered, how in the world do some stocks seem to defy gravity? We're talking returns of hundreds, even thousands of %, then this breakdown is for you. Today, we are dissecting a time-tested, heavily researched method designed to do one thing, and one thing only: find those super-performing stocks before they go supernova. It's called the Specific Entry Point Analysis, or SEPA for short.
And it really all boils down to this one single question. I mean, this isn't just a casual thought. It's the fundamental puzzle that pretty much every investor wrestles with, right? It's the question that keeps you up at night after you've missed a massive run-up, or even worse, sold way too early. This SEPA strategy wasn't just dreamed up one day. It was born from the obsession to find a real, repeatable answer to this very question.
So here's our game plan. We're going to trace the entire story of this strategy, starting right from the beginning with some painful failures. Then we'll see how it was built on the work of market legends. After that, we'll get into the nuts and bolts, the 5 core pillars, the 4-stage process to put it all into action, and we'll wrap up with something just as important: the mindset you need to actually make it work.
You know, every solid strategy has an origin story. And this one, well, it doesn't start with a string of brilliant successes. Actually, it's the complete opposite. It starts with an approach that failed and failed spectacularly. But it's right there, in that failure, that the seeds of a truly powerful method were planted.
The first strategy was something a lot of us can probably relate to: bargain hunting. The logic seems so seductive, doesn't it? You buy stocks that have been crushed, stocks trading for pennies on the dollar compared to where they used to be. They've got to be cheap, and they have to bounce back eventually, right? Well, the tough lesson learned was that these stocks are often cheap for a very, very good reason. They were broken companies, and they just kept getting cheaper. The results were, to use the source's own words, downright dreadful. It's a painful but critical lesson. Cheap doesn't mean value.
So that early failure lit a fire. Instead of just giving up, it launched this incredible 5-year quest for answers. From 1983 to 1988, this was an all-out obsession. I want you to picture it: spending endless hours in university libraries, not just reading but devouring every trading book you can find, taking pages of notes, even photocopying entire books to study line by line at home. This wasn't a hobby. It was a full-blown investigation into what really works in the market. And it was only after 5 years of that relentless dedication that things started to click.
Now, here's what's so cool about this journey. The realization was that the answer wasn't about inventing something brand new out of thin air. The puzzle pieces were already out there, scattered across the work of legendary traders and researchers from decades past. The real trick was to find them, understand them, and then put them all together into a system that actually worked.
And the big aha moment came from connecting the dots between 2 huge studies. First, there was Richard Love's book, where he dissected the common traits of stocks that went up 300% or more over a huge time span. Then, years later, a completely separate academic study by Mark Minervini did something similar for stocks that gained 100% a year. And because their time frames overlapped, you could compare their findings, and get this, their conclusions were nearly identical. This was a massive light bulb moment. It proved the core idea: if you want to find the next big winner, you have to create a detailed blueprint of all the past big winners.
So it was like assembling a dream team of market wizards. From Richard Love, you get the core idea: use history as your guide. From Edward Jensen, you get the concept of creating a detailed blueprint of the perfect stock. From the father of trend following, Richard Donchian, you get the ironclad rule of only trading with the trend. From William Jiggerell, a deep dive into chart patterns. And of course, from the legend himself, Jesse Livermore, you get the timeless practical wisdom on risk management.
So let's see how all of these powerful but separate ideas were blended together into one single actionable strategy. This is where all those ingredients get combined into a recipe for finding the market's most elite stocks. And the absolute central concept that came out of all this is what's called the leadership profile. Think of it as the ultimate resume for a stock. It's the ideal set of qualifications you're looking for. This profile isn't just theory. It's a data-driven model built by studying the biggest winners over decades. But here is the key distinction. It doesn't just look at how much a stock went up. It focuses on how fast it went up. The goal here is to find stocks that have the potential for explosive, rapid moves. Velocity is everything.
So the whole point of SEPA is precision. The goal is to get away from guesswork and instead identify a very specific low-risk moment to enter a trade that has a high chance of working out. It's about being surgical. And it does this by demanding that two worlds collide perfectly. The world of the company itself, its fundamentals, and the world of the stock's behavior in the market, its technicals. When the company's story and the stock's chart are telling you the exact same thing, that's the sweet spot.
Okay, now that we have the philosophy and the main goal, let's get into the mechanics. The whole SEPA framework is built on 5 foundational pillars. These are the absolute non-negotiables that have to be in place before you even think about placing a trade.
And here they are: trend, fundamentals, catalyst, entry points, and exit points. You can think of this as a 5-point pre-flight checklist, and every single one of them has to be checked off. You can't have 4 out of 5. Each one is crucial, and together they create a complete plan from beginning to end. Let's break each one down. First up, and you could argue it's the most important, is the trend. This totally contradicts that buy cheap strategy that led to those awful results in the beginning. The research is crystal clear. The biggest, most explosive stock moves don't start when a stock is scraping the bottom. They happen when the stock is already in a powerful, established uptrend. The first rule of SEPA is simple: swim with the current, not against it. That one filter alone will eliminate most of the stocks out there.
Second, you need strong fundamentals. A stock price can't just rise on hype alone. It needs rocket fuel. And that fuel is a dynamic, fast-growing business. SEPA demands to see real, hard numbers that prove this growth. We're talking about accelerating earnings, huge sales growth, and expanding profit margins. This stuff shows the company isn't just getting bigger, it's getting better and more dominant. And what's wild is that these signals often show up in the quarterly reports before the stock really takes off.
Number 3 is the catalyst. Look, you can have a great trend and amazing fundamentals, but what's the story? What's going to grab the market's imagination? There has to be some kind of specific event that gets the big money, the institutional investors who really move stocks, excited. It could be a game-changing new product, a huge drug approval, a massive contract, or even a rockstar new CEO. The catalyst is the spark that lights the whole thing on fire. And finally, we get to execution, your entry and exit points. You can do all the research in the world, find the absolute perfect stock, but if your timing is off, you're going to lose. The entry is about finding that precise moment of lowest risk to get in, but even more important is your exit plan. Look, no strategy is right 100% of the time. It's just not possible. That's why having a predefined stop loss is mandatory. It's not a sign of failure. It's just the cost of doing business. And on the flip side, you also need a plan for taking your profits so you can actually keep what you've made. Okay, so we've got the 5 pillars, the essential ingredients. But how do you actually use them when there are thousands of stocks to pick from? That's where SEPA's 4-stage filtering process comes in. It's designed to systematically narrow the entire market down to just a tiny handful of elite candidates. The best way to think about this is like a funnel. At the top, you pour in thousands of stocks. The very first filter is the trend template. Is the stock in a confirmed uptrend? Boom. That knocks out probably 80% of the market right there. Whatever's left goes through intense quantitative screens. We're talking earnings, sales, profit margins. The small group that makes it past that is then carefully compared against that detailed leadership profile. And finally, the few elite names that remain get a final manual review before any decision is made. It is a process of extreme selectivity. And this whole filtering process is designed to lead you to one specific moment, what the strategy calls the point of convergence. And this is such a powerful idea. The ideal trade doesn't happen because one thing looks good. It happens when everything lines up in your favor, all at the same time. The source uses this great analogy. Imagine 4 cars all approaching a 4-way stop from different directions, and they all arrive at the intersection at the exact same second. That single moment of perfect alignment, that's the point of maximum probability, and that's the only time you act.
So what are those four cars arriving at the intersection? First, you have the company's powerful fundamentals we just talked about. Second, you have the stock's chart showing constructive price and volume action, confirming big institutions are buying. Third, you need the overall market to be healthy and trending up, giving you a tailwind. And fourth, you have that compelling catalyst, the story that's driving all the interest. When all four of those things converge, the odds are stacked heavily in your favor.
But as we start to wrap this up, there's something that is absolutely critical to understand. You can have the most perfect, data-driven strategy on the planet, but it will fail if you don't execute it with the right mindset. The psychological part of this game is every bit as important as the technical part.
I think this quote from the source material just hits the nail on the head. Let that sink in for a second. Success in this field isn't about finding some secret, perfect system that never fails. It's about finding a sound strategy that makes sense to you and then committing to mastering it. Deeply understanding your own approach, knowing its strengths, and just as important, knowing its weaknesses, is so much more valuable than constantly jumping from one hot new strategy to the next without ever mastering any of them. And that leaves us with a final, really powerful idea to think about. In our search for success, whether it's in the markets, our careers, or any skill we want to build, maybe we spend a little too much time looking for the flawless method. This whole explainer suggests that what might matter way more is having the discipline, the focus, and the unwavering commitment to truly master the good method we already have. It's a question of where we put our energy, into the endless search or into deep mastery.
All right, let's just jump right in. We're all on the hunt for value in the stock market, right? I mean, who doesn't love the idea of finding a total bargain, some hidden gem that everyone else has overlooked? But what if the main tool we all use to spot these bargains, the PE ratio, is actually fundamentally broken? What if instead of leading us to treasure, it's actually leading us straight into a trap?
Of course, we've all heard this nugget of wisdom from the man himself, Warren Buffett. It's basically the golden rule of value investing. Find a great business that's on sale. And it makes perfect sense, you know? It feels so logical. This is pretty much the foundation of how most of us learn to think about the market.
But then you read a sentence like this, and it just completely flies in the face of everything we thought we knew. Useless. I mean, that's a seriously strong word. It suggests that this metric, this thing that thousands of analysts and investors use every single day, isn't just a little unhelpful. It might be actively pointing us in the wrong direction. So what on earth is going on here?
Okay, so here's our game plan. We're going to tear this whole myth apart. We'll start by digging into the cheap stock trap. Then we'll flip the script and look at the surprising reason why so-called expensive stocks are often the biggest winners. After that, we'll get to the heart of what really moves prices, and we'll wrap up with a totally new way to think about the PE ratio.
Right. Let's kick things off by challenging this conventional wisdom head-on. The price-to-earnings ratio, it sounds simple enough, but its biggest flaw? It's right there in the name. It's based on past earnings. But the stock market? Well, the market only cares about the future. And that one simple flaw is exactly what leads so many well-meaning investors right into what's called the cheap stock trap. You see, the belief that a low PE automatically means you found a bargain, well, that's probably one of the most dangerous assumptions you can make in investing.
So let's do a little thought experiment. I want you to picture it. It's late 2007. The market's feeling a little unsteady. You're a value investor. You're on the prowl. What does a bargain look like? Well, it probably looks like a huge household name company whose stock has taken a beating, right? Bringing its PE ratio down to a multi-year low. That seems like a textbook buy.
And this is exactly that scenario playing out with the insurance giant AIG. Just look at that chart. In late 2007, its PE ratio hits a 10-year low. I mean, according to all the textbooks, this stock is practically screaming value at the top of its lungs.
And boom, here is the trap in action. That 10-year low PE wasn't a buy signal. It was a giant flashing warning sign. The market was sniffing out disaster. It was the calm before the storm, a storm that ended in a 99% collapse. That low PE wasn't value. It was the market pricing in a catastrophe that was just around the corner.
And look, AIG wasn't some isolated case. This exact pattern played out all over the financial sector. You saw it with Morgan Stanley, where the PE actually went up as the stock was cratering, a totally bizarre paradox. You saw it with Bank of America, with Citigroup, time and time again. The lowest PE ratio in years was the kiss of death. So the takeaway here is absolutely critical.
A low PE often just means the market knows something you don't, and it's pricing in a really big problem.
Okay, so if the cheap stocks are actually traps, what about the expensive ones? You know, the ones with those sky-high, nosebleed PE ratios that make most value investors run for the hills? Well, this is where the story takes a really fascinating turn.
I love this slide because the contrast is just so stark. On the left, you've got the fate of our low PE bargain, AIG, and on the right, a classic high PE superperformer, Yahoo, back in the late 90s. One looked cheap and got absolutely obliterated. The other looked insanely expensive, and it went on to create fortunes.
I mean, just look at this number, 938. That was Yahoo's PE in mid-1997. By any normal standard, that's not just pricey, it's completely absurd. It's in another galaxy. And yet from that exact point, the stock rocketed up 7,800%. Unbelievable.
The Crocs example just hammers this point home. It's like bizarro world investing. If you had bought Crocs when its PE was at its absolute peak, over 60, you would have made a 700% return. But if you waited for it to get cheap on paper and you bought it at its lowest PE in history, you would have lost pretty much everything, a 99% loss. The market was telling you a story, but it was the complete opposite of what you'd think.
And this analogy just makes it all click, doesn't it? It's simple, but it's so true. You don't walk into a dollar store expecting to find a Ferrari. A Ferrari is expensive for a reason. It's got the performance, the quality, the demand. It's the same with the market's true superstars. They're going to command a premium because they're delivering something that nobody else is. So, if PE isn't the magic number we thought it was, then what is? What actually moves stock prices? Well, for that, we have to look past the numbers on a balance sheet and focus on the real engine of the market: people, human perception, and ultimately, demand.
This quote just nails it. A company can have the most beautiful balance sheet in the world, the lowest PE you've ever seen, but if nobody wants to buy the stock, guess what? The price isn't going anywhere. Prices only move when lots of people get excited enough to start hitting the buy button. At the end of the day, you need demand.
This all leads to a super common and really costly mistake. The source material calls it the broken leader syndrome. It's that temptation to buy a stock that was once a market darling after it's had a massive crash. You know the thinking, aha, here's my chance to finally buy this amazing company on the cheap. But what you're missing is that the company isn't a leader anymore. It's broken.
And Sun Microsystems is the absolute poster child for this. It had an incredible run in the tech boom, but then it peaked. Now imagine you're an investor who saw it fall 75% from its high. You'd think you were getting the deal of a century, but the party was long over. From that so-called bargain price, the stock went on to fall another 90%. Yesterday's hero is not today's bargain. And this right here is a mental reset we all need. People have this funny math in their heads. They think, well, the stock is already down 75%, so it can only go down another 25%. That's completely, utterly wrong. The second you buy it, 100% of your money is on the line. From your entry point, it can still go to zero. You can still lose everything.
All right, so where does all this leave us? Do we just toss the PE ratio in the trash? Well, not quite. We just need to start looking at it in a whole new light. We need to stop thinking of it as a valuation tool and start seeing it for what it really is, a gauge of market sentiment.
This slide just lays it out perfectly. From now on, when you see a low PE, instead of thinking cheap, I want you to ask, okay, what big problem is the market worried about here? And when you see a high PE, instead of thinking expensive, ask, wow, what incredible growth is everyone expecting? See, a high PE often signals a dynamic new leader, while a low one can be a major red flag. It's basically a barometer of expectation.
So if we're not going to fixate on PE, what should we be looking for? Well, the real super performers, the biggest winners, are almost always driven by these things. We're talking about strong, accelerating earnings, not just growth, but growth that's actually getting faster. We're looking for game-changing new products or catalysts that get people genuinely excited. You want visionary, entrepreneurial managers running the show, not just some stuffy caretakers. And finally, the company has to be riding a huge, scalable new trend. These are the things that attract big money and really move a stock price. And that really brings us to the final question, the big takeaway. Analyzing a balance sheet is one thing. It's like being an oceanographer who can explain the physics of a wave in minute detail. But actually making money in the market, that's about something else entirely. It's about learning to spot that wave when it's just starting to form and having the guts and the skill to actually ride it. So the real question is, which one are you trying to do?
In investing, we hear all the time that what you buy is everything. Pick the right company and you're golden. But what if I told you that when you buy is maybe even more important? What if timing is the real secret between making life-changing returns and just spinning your wheels for years? Today, we're going to dig into a framework that helps answer that one crucial question.
Yeah, that's the million-dollar question, isn't it? And we've all been there. You find this amazing company, you do the research, you buy in, and then nothing. Your money just sits there, dead for months, maybe even years. Or worse, you buy in right at the top, just as the huge move is ending. Timing feels like this impossible guessing game. But here's the good news. It really doesn't have to be.
I love this quote because it just nails the strategy here. Our goal isn't to be the hero who perfectly calls the absolute bottom of a stock. Nope. We want to be the smart investor who casually strolls in after we've confirmed the music is blasting and the party's in full swing. It's all about jumping on board with proven momentum to maximize our chances for big gains. So how do we know the party's actually started? Well, it all boils down to one simple but incredibly powerful principle, one that's almost like a law of physics for the stock market. It's really just inertia. A stock that's already moving up has this massive force behind it. Usually it's big institutions with deep pockets, and that force tends to keep pushing it up. On the flip side, a stock that's drifting sideways or going down will probably keep doing that until some major force comes in to change its direction. So our job is simple. We align ourselves with the primary trend. We don't fight the current. We find the strongest wave and we ride it. Okay, so if we're gonna ride this wave, we're gonna need a map. And it turns out, stocks, just like pretty much anything else, from businesses to products, have a surprisingly predictable life cycle. Understanding this cycle is the absolute key to knowing exactly when to get on board and, just as importantly, when to get off. Just look at this chart of Amgen. This is the perfect visual for this life cycle. I want you to think of it like a mountain expedition. First, you have the flat, boring base of the mountain. Then comes the exciting, powerful climb up. After that, you reach the treacherous, unsteady peak. And finally, there's the dangerous descent down the other side. Our entire job as traders is to figure out what part of that journey a stock is on. So let's break this map down, stage by stage. So, stage 1. This is the base of the mountain. We call it the neglect phase for a reason. Basically, nobody cares about this stock. The price just chops back and forth, going absolutely nowhere. There's no exciting news, earnings are probably flat, and the big institutional investors, they're not interested yet. This phase can drag on for months or even years. Buying here is a classic trap. The stock might look cheap, but it's really just dead money that could be working for you somewhere else. And here's what that stage 1 looks like in the real world. For 2 whole years, Amgen's stock just drifted. No real trend, no energy, no momentum. If you tried to buy in here hoping to catch the beginning of a move, you would have had a very, very long and frustrating wait. This is exactly what we want to avoid. But then this happens. Stage 2. This is it. This is where the magic happens. This is the powerful climb up the mountain. All of a sudden, something fundamentally changes. A breakthrough product, a huge earnings surprise, and the big institutional money starts flooding in. You'll see the stock explode out of that flat base on massive volume. This, right here, is the phase where legendary superperformance gains are made. And I want you to notice the character of this move. It's not a chaotic, random spike. It's orderly. See how it moves up in that beautiful stair-step pattern? It goes up, pauses, goes up, pauses. That is the footprint of big institutions carefully accumulating shares. They don't just dump all their money in at once. They buy systematically, creating a healthy, sustainable uptrend. This is the party, and this is when we want to show up. But of course, all good things must come to an end. Stage 3 is the summit of the mountain. The orderly, predictable climb of stage 2 is over. Now the price action gets wild, choppy, and erratic. And why is that? Well, it's because the smart money that got in early is now quietly selling. They're distributing their shares to all the latecomers, the public, who just heard about this hot stock. The risk here goes through the roof. Just look at the stock's personality change. It's dramatic. That smooth, calm climb from stage 2, it's gone. It's been replaced by these wide, violent price swings. The stock is fighting with itself. It's not making any real upward progress anymore. This volatility is a massive red flag. It's the market screaming that the big players are getting out. And after the top comes the fall. Stage 4 is the treacherous descent. The stock breaks down and enters a full-blown, undeniable downtrend. It starts making a series of lower lows and lower highs. The institutions are now selling hard, and anyone left holding on is watching their profits, and then their capital, evaporate. You want to be far, far away from a stock in Stage 4. And this right here shows you just how brutal a Stage 4 decline can be. The price just slices through all its key support levels and goes into a free fall. Trying to be a hero and buy the dip in a Stage 4 downtrend is the classic definition of trying to catch a falling knife. The trend is now your enemy, and you have to respect its power. Okay, so we have our map. The mission is crystal clear. Buy stocks in Stage 2 and avoid Stages 1, 3, and 4. But how do we go from just looking at a chart in hindsight to actually doing this in real time? How can we be sure we're not just guessing? We need a toolkit. This is the most important part. We cannot rely on gut feelings or what we hear on TV. We need an objective, black and white, rules-based system to confirm that a stock has truly entered that golden Stage 2 advancing phase. And lucky for us, one exists. All right, this is your pre-flight checklist, and it is non-negotiable. Every single box has to be checked. Let's run through it. First, the price has to be above its big long-term moving averages, the 150 and 200-day. That tells us the stock is in a long-term uptrend. Then, we need those averages stacked correctly, with the faster ones on top of the slower ones. This confirms that momentum is building. The 200-day average itself has to be climbing for at least a month, proving this isn't some flash in the pan. Now, this is key. We don't buy stocks off the floor. The price needs to be at least 30% above its 52-week low. It has to have already shown some real strength. And finally, we want leaders. A relative strength rating over 70 means this stock is outperforming 70% of the entire market. It's an A-plus student. If even one of these criteria isn't met, we pass. No emotions, no exceptions. Now, one last thing. Even within that big Stage 2 climb, stocks don't go straight up. They need to rest. They'll move up, then pause and consolidate in a pattern we call a base, and then move up again. Think of these like base camps on our mountain. Counting them helps us figure out how far along the journey we are. A breakout from a first or second base, that's your sweet spot, the safest and often most powerful entry. But by the time a stock is breaking out of a fourth or fifth base, well, the climb is getting old, it's tired, and the risk of a fall is way, way higher. Knowing when to buy is half the battle. The other, arguably more important half, is knowing when to get out and protect those hard-earned profits. So let's talk about spotting the warning signs that the party is winding down. The difference is just night and day, isn't it? On the left, you have that beautiful, calm, orderly accumulation happening in Stage 2. On the right, you have the chaotic, violent, sloppy action of a Stage 3 top. When you see a stock's character change from the picture on the left to the picture on the right, that is your cue. That's the market telling you that the big money is selling, and it's time to start taking your own profits and heading for the door. Wow, I mean, look at this incredible example from Netflix. Back in 2011, the stock absolutely shattered its long-term trend line on the biggest volume spike in its history. This wasn't a subtle hint. This was the fire alarm blaring. This was the institutions stampeding for the exits. And the most important part, this happened before the bad news about them splitting the company became public knowledge. The chart told you everything you needed to know, weeks in advance. And that right there brings us to the single most important takeaway from this entire framework. If you remember only one thing from our time together, please make it this. Here it is, the big aha moment. Just look at this chart of Vicor. The stock had an unbelievable Stage 2 run, fueled by insane earnings growth. But then, the chart started to change. It topped out and began a vicious Stage 4 collapse. And here's the kicker. By the time the company finally came out and reported disappointing flat earnings, the stock was already down nearly 70%. This is proof. The price leads, the news follows. By the time you read about it in the headlines, the smart money is long gone. Waiting for news confirmation is how you get destroyed. The chart always knows first. So I'll leave you with this question to think about. The next time your friend, your coworker, or some expert on TV gives you a can't-miss stock tip, are you going to get caught up in the story? Or are you going to pull up the chart, check the stage, and let the price tell you the truth? The answer to that question could make all the difference for your portfolio.
Hey there. You know, we're always told to look at a stock's price, right? Is it up? Is it down? But what if I told you that price tag is probably the least interesting thing about a company? Today, we're going to go way beyond the ticker.
We're going to build a mental toolkit that'll help you see any company's real story, its real potential. Let's get into it.
All right, so let's start with a classic investor's puzzle. You've got two stocks in front of you. One has been on an absolute tear. The chart just goes straight up. The other one looks like a bargain. It's got a super low price-to-earnings ratio. So which one do you buy? Your gut might be screaming, buy the cheap one, but, is that always the right move? This is exactly the kind of trap we can all fall into.
Because here's the key, and this is so important. That price tag, whether it looks crazy expensive or dirt cheap, it just doesn't tell you the whole story, not even close. A metric like the PE ratio can be totally misleading if you don't have the context. To really get what you're buying, you need a better framework, a way to classify the type of situation you're looking at.
And that's exactly what we're going to do. This isn't about some secret formula. It's about building a mental toolkit. Think of it as a set of lenses that lets you look at any company, in any industry, and immediately start asking the right questions.
This right here is the secret sauce. The best investors, they don't just ask, is this stock cheap? No, they ask, what kind of company am I looking at? Is it a leader dominating its market? Is it a challenger trying to take the crown? Is it a turnaround story coming back from the dead? That first step, just categorizing the company, changes everything.
So here it is. This is our mental filing cabinet. Almost any company you can think of will fit into one of these 6 buckets. You've got your dominant market leaders, their hungry top competitors, those slow and steady institutional favorites. Then you have the high-risk, high-reward turnarounds, the economically sensitive cyclicals, and, well, the laggards, the ones you probably want to steer clear of. Okay, let's dive into the first and, honestly, the most exciting part of our toolkit. We're talking about the winner's circle. These are the companies that often produce those monster returns we all dream about, the market leaders and their top competitors. So what is a market leader, really? It's not just about being the biggest company. It's about being the strongest. These are the top dogs, the number 1, 2, or 3 players in their field. And crucially, they're not just sitting on their throne, they're actively stealing market share from everybody else. They've got all the momentum.
Now, this quote gets at a fascinating psychological trap. It sounds nuts, right? Why would you be afraid to buy the best of the best? Well, it's because by the time you notice them, their stocks have usually gone on a huge run, and people think, oh, it's too expensive, or I must have missed the boat.
But letting that fear win can be a massive mistake. Just look at Cisco back in its heyday. From 89 to 93, the stock didn't just climb. It went up more than 13 times over. And this wasn't some random fluke. It was powered by absolutely insane quarterly earnings growth, averaging over 100%. The price was just playing catch-up to how good the business was. And it's the exact same story with another name you definitely know. In the early 80s, people thought of Walmart as just some regional store, but under the surface, its earnings were growing at an average of 38% for 14 quarters in a row. For investors who saw that leadership emerging, the result was a jaw-dropping 1,000% gain.
But, it's not always about the king on the throne. Sometimes the most explosive moves come from that number 2 player, the top competitor, who's about to make a run for the crown. That's when you see these incredible, disruptive shifts that change an entire industry.
Let's look at one of the most legendary examples of this. Back in 2009, you've got Blockbuster, the old guard, looking really cheap on paper with a tiny PE ratio of just 2. And then you have this upstart, Netflix, looking crazy expensive with a PE of 32. But just look under the hood. Netflix's sales and earnings weren't just growing, they were accelerating. Blockbuster's business was literally going backward. So it brings us right back to that first question, doesn't it? Which one was actually the bargain here? The one with the low price tag and a dying business? Or the one with the high price tag and a business that was about to take over the world?
And yeah, the chart says it all, better than I ever could. The expensive stock, Netflix, went on one of the greatest runs in stock market history. The cheap one, Blockbuster, went to 0. It's a brutal but perfect example of why the story and the momentum of a business matter so much more than a simple valuation number.
Okay, so we've covered the high flyers. Now let's grab some different tools from our kit for what we call special situations. These are the turnarounds and the cyclicals. They can be incredibly rewarding, but man, they play by a completely different rulebook and you really have to know what you're looking for.
To understand a true turnaround, just think about Apple in the late 90s. Things were so bad that Michael Dell, one of their biggest competitors, basically said the company was toast and should just be liquidated. It was seen as a has-been, a former leader on its way out. And that point of total despair, that's often where the opportunity begins. But then, the catalyst arrived. First, the iPod, and then the world-changing iPhone. This wasn't just about cutting costs. This was pure innovation, creating brand new markets out of thin air. And the result? For 8 straight years, Apple's earnings grew at an average of 114% a year. The company was completely reborn. And the stock price? Well, it just did what stocks do when earnings go ballistic. From that low point of despair, it soared more than 10,000%. It's the ultimate story of a company going from a laggard everyone had given up on, right back to being one of the most dominant market leaders on the planet.
All right, now for our second special situation, the cyclicals. These are companies, think automakers, steel companies, home builders, whose business is basically tied to the heartbeat of the economy. Their fortunes rise and fall with the business cycle, and that means you have to analyze them in a totally different way.
Now, with cyclicals, you have to flip your thinking about PE ratios completely upside down. It's a total paradox. At the bottom of a recession, when the news is awful and their earnings have been crushed, their PE ratio looks insanely high. That's usually the time to buy. And at the top of the boom, when everything's great and their earnings are soaring, their PE looks super cheap, and that is often a massive warning sign that it's time to sell.
Okay, so we've talked about how to classify individual companies. But here's the thing. No company lives in a vacuum. A great company in a dying industry is going to struggle, but even a so-so company in a red-hot industry can do incredibly well. So let's zoom out and look at the bigger picture, how to spot the leading industries.
History gives us some major clues here. The biggest, most explosive stock market winners, they tend to cluster in just a few specific groups. When you look back, they overwhelmingly come from areas like consumer retail, technology and software, biotech, and entertainment. Knowing where to go hunting is half the battle.
And what's really cool is that these leading industries, they tend to follow a very predictable pattern. It's like the circle of life for innovation. It starts with a new idea, a new technology that's expensive and only for a few people. Then, as it gets better and cheaper, it hits that explosive penetration phase where it grows like crazy. Eventually, the market gets saturated, everyone has one, and it becomes a slow-growth slugfest. We've seen it with cars, with TVs, with PCs. It happens over and over.
So the real takeaway here is that this cycle is timeless. The technology changes, the company names change, but the pattern of innovation, explosive growth, and eventual slowdown, that stays the same. The biggest opportunities are always in that incredible penetration phase. And that leaves us with one last question to think about. Using this toolkit, what major new industry do you see that's just beginning that climb today?
So have you ever looked at a stock chart that's just gone vertical and wondered, what's the secret sauce? What separates the good stocks from the truly great ones? I mean, the real superperformers, the ones that can deliver those explosive, absolutely life-changing returns. Well, I can tell you it's not luck, and it's definitely not about buying a familiar company just because it's cheap. Today, we're going to unlock the playbook. We're breaking down the fundamental traits that the biggest market winners all have in common. So if you're ready to learn how to spot these beasts before they take off, let's dive right in.
All right, before we get to the good stuff, we have to talk about a massive, and I really mean massive, mistake that trips up so many investors. It's that siren song of the so-called bargain. You know the one. The idea that a stock that's fallen a long way is automatically a great deal. But the reality? Well, the reality is, when a stock suffers a major break in price, there is almost always a very good reason for it.
I mean, think about it. You've seen this happen, right? You see a famous company, a brand you know and trust, and its stock has just been crushed. It's down 50, 60, maybe even 70%. And what's that first instinct? It's probably, whoa, what a deal. This is my shot to buy a great company for pennies on the dollar. But is that really what's going on here, or are you about to walk straight into a trap?
Well, this chart of Citigroup from back in the 2008 crisis, it tells the whole story. You can see the stock price just falling off a cliff. And as it was falling, it looked like a bargain to so many people. But here's the key. Look at that bottom panel. The price wasn't just falling for no reason. It was perfectly tracking a catastrophic collapse in the company's actual earnings. The stock dropped 95%. That's not a discount. That's a huge flashing red sign that the business itself was completely broken.
And believe me, Citigroup was not an isolated case. During that same time, you had General Motors, the iconic car maker. It shed 95% of its value. You had AIG, the insurance giant, which crashed from over $100 a share all the way down to 33 cents.
Both of them got kicked out of the Dow Jones Industrial Average. The lesson here is kind of brutal, but it's simple. These stocks were not bargains. They were broken. The market doesn't give a hoot what a stock used to be worth. It only cares about one thing, its future ability to earn money.
Okay, so if we're not supposed to be digging through the bargain bin for damaged goods, what should we be looking for, right? This is where we pivot from the problem to the solution. Because the force behind almost every single super-performing stock isn't a low price. It's a powerful, undeniable engine of growth.
And that brings us to the single most important rule in this entire playbook. Seriously, if you take away only one thing from our chat today, let it be this. You know how in real estate the mantra is location, location, location? Well, in the stock market, the secret is earnings, earnings, earnings. A company's ability to grow its profits, that's the fuel. That's what drives its stock price. Everything else, it's pretty much just noise.
So why are earnings the magic ingredient? What's the big deal? Well, it's because individual investors like you and me, we don't really move the needle. The real power lies with the giants, the big dogs, the mutual funds, hedge funds, pension funds. These guys command trillions of dollars, and their entire focus is on one thing, earnings. So when a company shows strong earnings growth, these institutions pile in with enormous buy orders. And that is what creates those massive, explosive upward moves in a stock's price.
Okay, so we know earnings are the key. But how do we actually spot a company that's about to take off? Well, the first major clue is something Wall Street calls an earnings surprise. Think of it as a signal that something really, really positive is happening under the hood.
So what exactly is an earnings surprise? It's actually pretty simple. Before any company reports its profits for the quarter, all the Wall Street analysts make their best guess at what the numbers are going to be. An earnings surprise is when the company just completely blows those guesses out of the water. They report profits that are way higher than anyone was expecting. It's kind of like the market's version of getting a report card back with a big, shiny A+ when everyone predicted you'd get a B.
And this is where the magic really happens. A big surprise like that creates this powerful chain reaction. First, the analysts are forced to admit, oops, we got that wrong, and they have to revise all their future forecasts upward. That revision gets the attention of those big institutional investors we were just talking about. Their computer models start flashing green, signaling a buy, and as their money starts pouring in, the stock price just climbs. It's this beautiful, virtuous cycle.
Now, this leads to a pretty memorable phenomenon known as the cockroach effect. Yeah, I know, the name is a little gross, but the idea behind it is powerful. It's simple. If you see one cockroach in your kitchen, there are probably a lot more that you can't see. In the stock market, it means that one big positive earnings surprise is rarely a one-time thing. It often signals that there's been a fundamental improvement in the business, which means more good news is probably on the way in the next few quarters.
And you can see this cockroach effect playing out perfectly right here with Urban Outfitters. Just look at the left side of this chart. You see that series of positive surprises marked by those little upward arrows? Well, it's followed by a beautiful, steady climb in the stock price. But then, look what happens over on the right. The surprises turn negative, and boom, the stock completely flatlines. The message here is crystal clear. Good news tends to lead to more good news, and that's exactly what drives a stock higher.
All right, so positive surprises are a huge first clue. But to find a true super performer, we've got to go one level deeper. It's not just about having earnings growth, it's about the acceleration of that growth. This right here is where we find the real sweet spot, the super performance zone.
This diagram right here shows the typical life cycle of a big winning stock, and it is absolutely key to our whole strategy. Now, you can forget all the other stages except for one, stage 2. That is the sweet spot. That's the moment a company transitions from just being, okay, to being truly great. It's when those positive surprises start rolling in and the big institutional money really starts to notice. Our entire goal is to get good at identifying and buying stocks right as they enter this explosive stage 2 phase.
So what does this acceleration actually look like in real numbers? Well, this is it right here. Just imagine a company goes from its earnings declining by 34% in one quarter to suddenly growing by 12% the next. I mean, that's a huge turnaround. But it doesn't stop there. The very next quarter, that growth accelerates to 44%. And the quarter after that, it jumps again to 83%. See that? Each quarter is better than the last. This increasing momentum, that is the jet fuel that launches a stock into orbit.
And hey, this isn't just some theory on paper. Look at these real-world examples. You've got Crocs on the left. It had an unbelievable run that was fueled by 6 straight quarters of triple-digit earnings growth. And Vicar on the right, a very similar story, rocketing up 460%. You can literally see the stage 2 liftoff happening in both of these charts. The companies are totally different, but the pattern, that explosive earnings acceleration, is exactly the same.
But there's a crucial catch here, and you've got to pay attention to this part. This growth has to be real. It can't be coming from some clever accounting gimmick or a one-time cost cut. You need to see strong and accelerating sales to confirm that the earnings growth is the real deal. Real growth is driven by customers buying more stuff, not by accountants moving numbers around on a spreadsheet.
Now, Apollo Group is the perfect example of how this plays out over the long term. Just look at the power of this trend. Their annual earnings growth didn't just stay high, it literally accelerated for 4 straight years, going from 28% all the way up to 55%. And what did the stock do? The chart just mirrors that climb perfectly. This is how you find those legendary multi-year winners, by identifying this exact pattern of sustained acceleration.
So we know what gets the party started, right? Accelerating earnings. But what's just as important is knowing when the party's over. If acceleration is the big green light to go, then its opposite, deceleration, is the giant flashing red flag telling you it's time to get out of the way.
Yep, just as acceleration is your buy signal, deceleration is your sell signal. Dell Computer is a classic example. Through the late 90s, this company was an unstoppable force. We're talking 80% average earnings growth. The stock was an absolute rocket ship. But then came the warning sign. In 1999, its growth slowed to 28%. Now, for a normal company, that's great. But for a superstar stock like Dell, that slowdown was a massive red flag. And sure enough, that was the exact peak, right before the stock began a painful, multi-year collapse.
The takeaway is staring us right in the face. The incredible rocket ride up was powered by that insane 80% growth. And the ride ended the moment that growth rate broke its upward trend. And why? Because those big institutions, the ones that drove the stock up in the first place, they saw the story change from acceleration to deceleration, and they all started hitting the sell button at the same time.
Okay, let's pull all of this together into a simple, actionable checklist. Number 1, ignore the bargain trap. You've got to focus on future growth, not a company's past glory. Number 2, remember the mantra. It is all about earnings. Hunt for those significant positive earnings surprises. Number 3, and this is the big one, look for acceleration. The rate of earnings growth has to be increasing quarter over quarter. And finally, number 4, watch for deceleration. A real slowdown in that growth rate is a major red flag.
So, I'm going to leave you with this question to think about. Go ahead and look at your own portfolio right now. Are you holding stocks because of what they used to be, because of their past glory, or are they positioned for real future growth? Can you actually see that clear, undeniable acceleration in their business? Because answering that question, honestly, well, that could be the key to unlocking your own super performance.
All right, let's talk about assessing earnings quality. You know, not all earnings are created equal. A company can show a profit in a whole lot of different ways, and honestly, some are way more trustworthy than others. By the end of this, you're not just going to be reading earnings reports, you're going to be an earnings detective, ready to find out what's really going on.
So, imagine this. You're scrolling through the news and a headline catches your eye. XYZ Corp just posted a huge 25% gain in earnings. Now, your first thought is probably, wow, that's amazing. This stock is a rocket ship. But hang on a second. Is it really that simple? Is this an automatic buy?
Well, on the surface, yeah, it looks incredible. But this is where we put on our detective hats. You dig into that report just a little bit, and you find something interesting. A little line item called an unusual gain. Turns out, a huge chunk of their profit, a whopping 84 cents per share, came from selling off an asset, something that has absolutely nothing to do with their actual day-to-day business.
So what happens when we adjust for that? Well, if you pull out that one-time gain just to see how the core business performed, the story completely flips. That impressive 25% gain, it turns into a 7% drop from last year. And that right there is exactly why earnings quality matters so much.
Okay, so how do we actually spot these kinds of things? Our first stop is the profit and loss statement, the P&L. This is ground zero for where companies can get a little creative with their numbers. Let's look for some clues.
The first big gimmick is that non-recurring income we just saw. See, as an investor, what you really care about are earnings that come from the company's main business, things they can do over and over again.
Think about a coffee company. You want their profits to come from selling more coffee, right? Not from selling the building their coffee shop is in. That property sale tells you nothing about how their coffee business is actually doing.
Now, on the flip side of a one-time gain, you've got the one-time charge. This is a classic move. When a company has a pretty weak quarter, you might see them book this big, supposedly non-recurring expense. They'll tell you, hey, don't worry about it. This is just a one-off thing. Everything will be back to normal next quarter. But the real question for us is it really a one-off?
And that's the key, right here in this quote. It all comes down to the pattern. Is it really a one-time charge if the company seems to have a one-time charge every other quarter? Some companies are, let's say, habitual abusers of this excuse. If you see this popping up again and again, it's a massive red flag. It probably means management is trying to paper over some ongoing problems.
And this really gets to the heart of what we're looking for. There's sustainable growth, and then there are short-term fixes. Real, healthy growth comes from the top line, selling more stuff, gaining market share, creating new products. The unsustainable stuff, that's things like aggressive cost-cutting. Sure, a company can close a plant or cut jobs to make the numbers look better for a little while, but you can only do that for so long. Eventually, you run out of things to cut, and you have to actually grow the business.
Okay, so we've snooped around the P&L. Now it's time to dig a little deeper to a place where some of the best clues are hidden, the balance sheet. This is where you really get the story that's going on beyond the headlines.
You know, just by looking at inventory, you can find some incredible stories. Take this amazing case study of Encore Wire. Back in the mid-2000s, copper prices were going absolutely parabolic. And if you dug into Encore's balance sheet, you could see they had been smartly stockpiling huge amounts of copper when it was cheap. So as copper prices shot through the roof, their costs stayed low, their profit margins exploded, and well, you could see what happened to their stock price.
But, and this is a big but, inventory can also be a huge red flag. What you want to see is inventory growing more or less in line with sales. When you see a company's inventory starting to pile up way faster than its sales are growing, that could mean trouble is just around the corner. It's often a sign that demand for their products is drying up. And that can lead to this nightmare scenario, the double whammy. Just follow the numbers here. Sales are up a decent 11%. But look at their finished goods inventory, the stuff that's just sitting in their warehouses. It's up a massive 79%. And at the same time, their receivables, that's the money customers owe them, is up 33%. So not only is their product not selling, but they're also having trouble getting paid for what they have sold. This is a big, flashing warning sign for future earnings.
So, we've gone through the P&L, we've checked the balance sheet, but you know what? It doesn't matter how good a report looks on paper. The ultimate judge and jury is the market itself. How the stock actually reacts tells you what Wall Street really thinks. So, let's read the market's verdict.
And a huge piece of that verdict is something called company guidance. This is basically when management gets on the phone and tells everyone what they expect to happen in the future. And when a company not only crushes their earnings, but then also issues positive guidance, raising their forecast for the next quarter, that's a massive vote of confidence from the people who know the business best. That's the sweet spot. And the market's reaction to guidance can be even more powerful than its reaction to the earnings themselves. Just look at Rosetta Stone here. In 2009, they issued what's called downside guidance, and the stock was just blasted. You see that huge gap down? It opened the next day way lower and basically never looked back. It just goes to show you how much stock prices are driven by what's expected to happen next. Now, let's look at the good stuff. One really interesting pattern is something called post-earnings drift. The idea is that even if you miss that first big pop after a great earnings report, you might not be too late. As you can see with Lululemon, a really strong earnings surprise can create this positive momentum that just keeps going for months, leading to this nice, steady upward trend.
And the final market reaction we're looking for is resilience. A true super-performing stock doesn't just go up, it stays up. Check out Netflix here back in 2010. It had a huge gap up on earnings, pulled back for just a tiny bit, and then bam! It powerfully charged ahead to new highs. That ability to shake off any selling and keep climbing, that's the real mark of a winner. So, we've learned how to spot the tricks and how to read the market's reaction. Now, let's put it all together. What does the absolute gold standard, the perfect earnings report, actually look like? This is what it means for a company to be hitting on all cylinders.
But first, let's look at the opposite. This table right here is a huge warning sign, deceleration. You can just see the momentum draining away. Earnings growth goes from 83% all the way down to negative 34%.
Revenue growth slows to a crawl and then shrinks, and their profit margins are getting squeezed quarter after quarter. This is a company that's losing its magic fast.
Now, contrast that with this. This is the dream. This is what you're looking for. Everything is moving in the right direction, and not just growing, but accelerating. Earnings growth is getting faster. Revenue growth is getting faster. And, this is so important, their profit margins are expanding at the same time. This is the kind of powerful combination that can really light a fire under a stock.
And this magical combination actually has a name. It's called a Code 33. Think of it as the ultimate recipe for a super-performing stock. It means you have at least 3 straight quarters where earnings, sales, and profit margins are all accelerating together. When a company pulls this off, it's pretty clear proof that they're doing something very, very right.
And if you want to see what this looks like in the real world, just look at Monster Beverage. This is the textbook example of a Code 33 winner. From 2003 to 2005, you can see that incredible acceleration across the board in their earnings, their sales, and their margins. And what was the result? An absolutely legendary, explosive run in the stock price.
So, there you have it. We've gone from spotting accounting gimmicks to decoding the balance sheet and finally to identifying those rare Code 33 winners. It really all comes down to one question. The next time an earnings report comes across your screen, are you just going to be a reader or are you going to be a detective?
Hey, welcome. Today, we're going to break down a really powerful investment strategy that pretty much flips conventional wisdom on its head. It's all about spotting the signs of a new bull market before everyone else does, and, being in a position to capture those huge gains. So, let's dive in.
All right, so let's just start with the million-dollar question. If you're chasing that true super performance in your portfolio, when do you think the big money is actually made? Is it when the economy looks fantastic and all the headlines are glowing, or is it somewhere else entirely?
So here's the secret. The truly life-changing returns, they almost always happen right at the beginning of a new bull market. But, and this is a big but, by the time the major indexes like the S&P 500 actually confirm that a new rally is underway, well, a lot of the best opportunities have already left the station.
And this is the paradox, isn't it? If the biggest profits are made early on, but the absolute best stocks start their sprint weeks or even months before the rest of the market catches on, how on earth do you catch them? How do you know when to get in before the train is gone for good? Well, the answer is you learn to follow the leaders.
So here's our game plan. First, we'll tackle why most investors completely miss the starting gun. Then, we'll define what a real market leader is. After that, we'll get into how to spot them, look at some mind-blowing real-world examples, understand the risks, and finally, build you a brand new playbook.
All right, let's jump right into Section 1, the million-dollar question. We're going to explore the psychological traps that keep most people frozen right at the exact moment they should be taking action.
At a market bottom, the average investor is just an emotional wreck. They're totally gun-shy after getting hammered with losses. They're not even thinking about new opportunities. They're just praying to get back to even on their old losing stocks. And of course, they're glued to the news, which is almost always screaming doom and gloom. So here's the bottom line. They are completely psychologically unprepared to buy a stock that looks too high when everything else feels so terrible.
Which leads us to Section 2. If we can't trust the news, and we definitely can't trust our own battered emotions, what can we trust? Well, the answer lies in this very specific group of stocks that pretty much act as a lighthouse in the storm.
Okay, this is the definition you need to burn into your brain. A market leader isn't just some big, famous company. No, it's a stock that shows incredible strength. During a bear market, it holds up better than everything else. It's the very first to turn the corner and head up. And most importantly, it explodes to new 52-week highs while the rest of the market is still scraping the bottom.
This chart just lays it all out perfectly. See that solid black line? Those are the leaders. They bottom out first, and they shoot up the fastest. They're followed by the dashed line, which is their industry group, and then the dotted line, which is the overall market. And then way, way behind, you have the laggards. So by watching that solid black line, you're essentially getting a sneak peek of where the entire market is about to go.
Now on to Section 3. Signals in the noise. Look, the theory is great, but how do you actually spot these leaders in real time, when it really counts?
You're looking for a very specific sequence of events. First, you'll see a small group of stocks just stop going down. They'll start trading sideways, building these stable price patterns we call bases. Think of it as them building a launch pad. Second, you'll notice that when the market has a bad day, these stocks barely even flinch.
Third, when they finally do break out to new highs, most of them actually hold those gains. And finally, you start to see more buying volume on up days across the market than selling volume on down days. That's the market giving the green light to what the leaders already told you.
But the most powerful signal of all is something called divergence. While the S&P 500 is still making lower lows, bleeding out, you'll see a handful of stocks quietly making higher lows. It's like they're refusing to go down with the ship. Then, while the indexes are still officially in a downtrend, bam, these leaders burst onto the 52-week high list. That stark contrast, that divergence, that is your call to action.
Okay, Section 4. Time for the proof. Does this strategy actually work in the real world? Let's walk through a few historical examples that are, well, they're nothing short of spectacular.
Just take a look at pharmacyclics back in 2010. On that bottom chart, you can see the NASDAQ index hitting a fresh new low on February 4th. Not a good day. But now look at the top chart. On that exact same day, PCYC broke out of its base and was rocketing to new highs. This is that divergence we were just talking about, right there in crystal clear detail.
So what was the reward for spotting that signal? Well, over the next 33 months, pharmacyclics ran up an incredible 1,500%. That right there is the power of catching a true market leader right at the turn.
Here's another classic from the 1990 bear market. As the NASDAQ was just falling off a cliff, Amgen, well, it just went sideways. It basically ignored the crash and absorbed all the selling. Then, just 22 days after the market bottomed, while the index was still down 25% from its highs, Amgen hit an all-time high.
And once that weight of the bear market was finally lifted, Amgen just took off, gaining 360% in only 14 months. It was one of the very first stocks to signal that a new bull market was here.
Now, what's really fascinating is that this stuff usually doesn't happen in a vacuum. This is where you look for what's called a technical theme. On the very same day that Amgen broke out, so did American Power Conversion, a company in a completely different industry. The price action was nearly identical. That's a huge signal that a powerful, broad-based recovery was starting. And if you thought Amgen's return was impressive, check this out. APCC went on to advance a mind-boggling 4,100% over the next 50 months. This is what Superperformance looks like, and it all starts by following the leaders.
But this leads to a really critical point in Section 5, and you have to remember this. This technique, it's a double-edged sword. Just as leaders can guide you into a new bull market, they can also warn you when it's about to end.
The signals are basically a perfect mirror image. At the top of a market, after a long run, you'll start to see those same high-flying leaders begin to stumble and break down, even while the indexes are still chugging along. Why? Because the smart money is quietly rotating out of them and into boring defensive stocks or the laggards. When you see that start to happen, it's a massive warning shot. It's telling you the party is probably coming to an end.
So let's wrap this all up in our final section. What's the actionable playbook here? How do you actually put this powerful strategy to work?
Okay, here are the rules to live by. First, and this is maybe the most important, you have to tune out the media noise. Instead, concentrate all your attention on the list of stocks making new 52-week highs. That's where the leaders live. At the same time, actively avoid the 52-week low list. Just don't go there. When it's time to buy, you buy the strongest stocks first, the ones that break out with real power. And finally, always remember that the leaders of the last cycle are almost never the leaders of the next one. You always have to be looking for the new crop.
Look, the big takeaway is this. Market cycles are always turning, and history has shown us time and time again that new leaders are always stepping up to the plate. So the real question you've got to ask yourself is, when the next market bottom finally gets here, are you going to be paralyzed by the scary headlines, or are you going to be doing your homework, tuning out all that noise, and looking for the leaders?
You know, they say a picture is worth 1,000 words, but what if it was worth $1 million? Today, we're diving into the idea that a stock chart is exactly that, if you know how to read it. We're going to decode the market's language, not with some crazy formulas, but by understanding the very human story that's told through price and volume.
So, let's kick things off with this incredible analogy from the legendary trader Mark Weinstein. Think about it, cheetah. Yeah, it's the fastest thing on land, but it doesn't just run around wildly. No, it waits, and it waits, until it is absolutely certain it can make the kill. Only then, when the odds are stacked in its favor, does it strike. That right there, that patience, that precision,
That's the heart of what professional trading is all about.
All right, so here's our roadmap for today. We're going to start by tearing down some common market myths. Then we'll learn the actual language of charts. After that, we'll get into the nitty-gritty of a powerful pattern called the VCP footprint. Then we're going to challenge that old advice to buy low, sell high. And of course, we have to talk about the charts that can trick you. And we'll wrap it all up by talking about the right mindset for a trader. Okay, let's dive right in. First up, we're going to take on a big idea, a cornerstone of financial theory that gets taught in, well, pretty much every business school. And understanding why it's flawed is the first step to seeing the opportunities that everyone else misses.
So on one side, you've got this academic theory, the efficient market hypothesis. It basically says that markets are perfectly rational and all information is already baked into a stock's price, so you can't beat the market. But then there's reality, the human reality, where decisions aren't made by robots, but by people, driven by ego, fear, greed, and hope. And it's in that gap between theory and reality, that's where the opportunity lies.
So, if the markets aren't these perfect, efficient machines, how in the world do we spot those opportunities? Well, the answer is in our next section. We're going to learn how to read charts, not as some kind of crystal ball, but as a language that tells the story of the timeless battle between buyers and sellers, supply and demand.
Okay, this is absolutely key. You've got to get this. Chart patterns don't cause a stock to go up or down. They are the effect. They are the footprint left behind by human psychology. And because basic human emotions like fear and greed never, ever change, the patterns they create on a chart are just as relevant today as they were 100 years ago.
This leads to a really important point. And the best way to think about it is like a train schedule, right? You expect the 6:05 train to show up around 6:05. If it's suddenly 7 p.m. and there's still no train, you know something is seriously wrong. Well, charts are like that train schedule for stocks. They help you understand what a stock should be doing. And when it starts acting weird, when it goes off schedule, that's your red flag. It makes the decision to sell so much simpler.
All right, enough theory. Let's get down to brass tacks. We are about to dive into what our source material calls the holy grail of technical setups. This is a very specific signature that a stock leaves behind when it's getting ready for a massive move.
And it's called the Volatility Contraction Pattern, or VCP for short. So what is it? Just picture a stock's price bouncing up and down. Now imagine those bounces getting smaller and smaller and tighter and tighter. That tightening action is a huge clue. It tells you that the sellers are running out of steam and that strong institutional buyers are quietly soaking up all the shares.
Okay, check this out. This chart of Meridian Bioscience is a textbook example of VCP in action. Look at how the corrections get smaller over time. First, you have a 31% drop, big one. Then it calms down to a 17% drop. Then an even smaller 8% drop. And finally, look at that, just a tiny 3% wiggle. That progressive tightening was the signal that all the selling was finished. And what happened next? The stock shot up 100% over the next 15 months.
So how can you spot this in the wild? Well, you can break it down into 3 simple things to look for. Think of it as the technical footprint. First, there's time. How long has the stock been consolidating? Second, price. How deep are those corrections? And third, symmetry. How many of those little contractions can you see? This gives you a framework to analyze any setup.
But what's actually happening here? What's the psychology behind this pattern? Well, as the stock pulls back, you get 2 groups of people who want to sell. You've got your trapped buyers who bought at a higher price and are just desperate to sell and get their money back. And then you have your profit takers who are cashing in. A really strong stock will absorb all of that selling pressure. And as it does, the price gets tight and the volume just dries up. That's the signal that the process is complete.
All right, get ready for this next idea because it is going to go against pretty much everything you've probably ever heard about investing. We're always told, buy low, sell high. But what if? What if the real path to huge gains is to buy high and sell much, much higher? Let's take a look at Taser. Back in late 2003, it had already run up 540% and was hitting an all-time high. Now your brain is screaming, it's too expensive, I missed it. But here's the secret. A stock at a new all-time high has a massive technical advantage. There is 0 overhead supply. That means there's nobody who bought it a year ago at a higher price just waiting to dump their shares and break even. Every single person who owns the stock is sitting on a profit.
That removes a huge source of selling pressure. And what happened after Taser hit that so-called expensive all-time high? It rocketed up another, get this, 1,800%. The real move was just getting started. And look, this wasn't just a one-off thing. It happens over and over. Take a look at Yahoo back in the 90s. Its initial run was impressive, sure, but the truly life-changing 4,300% gain came after it broke out to that new all-time high.
And if you thought that was crazy, check out Monster Beverage. Buying it at its all-time high in 2003 would have felt like you were chasing it, right? But that was the ticket to an unbelievable 8,000% run. The lesson is crystal clear. A new high is very often the starting line, not the finish line.
Okay, so buying high sounds great, right? But, and this is the big but, not every stock that hits a new high is a winner. In fact, many of them are traps. That's why this next section is so important. We're going to talk about risk management and how to spot those deceptive charts that look good on the surface but are designed to fail.
So here are 3 huge red flags you need to watch out for. First, avoid stocks that have had super deep corrections, like more than 60%. That usually means something is fundamentally broken. Second, be very wary of sharp V-shaped recoveries. Great stocks need time to build a base. And third, be careful around obvious support levels because the big players know you're looking at them too.
You can really see the difference when you put them side by side. On the left, you've got a healthy, patient consolidation. It takes its time, works through all the sellers, and forms those nice, tight contractions. On the right, you've got this rushed, V-shaped pattern. It just rockets straight back up without building any kind of solid foundation. That's a classic failure-prone setup.
So remember how I mentioned to be wary of those obvious support levels? Here is exactly why. The pros, the big institutions, they know exactly where amateur traders put their stop-loss orders. A shakeout is when they deliberately push the price just below that obvious level. This triggers a flood of selling from all the weak holders. And once all those people have been shaken out of the stock, it's free to begin their real move higher.
All right, we've covered a ton of ground. We've talked about patterns, psychology, and risk. So how do we pull all of this together into a mindset, a discipline, that actually works? That's what this last section is all about. You know, it all comes down to this one simple, powerful idea. As a trader who uses stop losses, you are by definition a weak holder. There's no getting around that. So the key is to be the last weak holder to get on board. You have to patiently wait for the consolidation, wait for the shakeouts to happen, wait for that volatility and volume to completely dry up. You only enter after all the other weak hands have been flushed out and the supply of stock for sale has vanished. So I want to leave you with a final question to think about. After everything we've looked at today, how price and volume really just mirror that timeless dance of human fear and greed, you have to decide for yourself. Is a stock chart just a random collection of data points? Or is it a rich story of supply and demand, a footprint of human behavior just waiting for someone like you to read it?
You know, we're always told to invest in what we know. You know, the big familiar companies we see every single day. But what if I told you the greatest opportunities, the truly life-changing investments, are actually hiding in plain sight, in companies we've never even heard of, right before they become household names? Today, we're going to dive into a powerful strategy that completely flips that conventional wisdom on its head and shows us exactly how to spot these super performers in their infancy.
All right, so here's our game plan. First, we're going to start with the hunt for these elite stocks and define the key pattern you absolutely need to look for. Then, we'll walk through some legendary examples to see this thing in action. After that, we'll get into the nitty-gritty, the specific rules of the game, what to do when the pattern fails, and that's super important. And finally, how to apply all of this to find the next generation of market leaders.
So let's jump right in. What is the core challenge for every single investor out there? It really is the multi-million-dollar question, isn't it?
Yeah, how do you do it? How do you get in on the ground floor? Not after the story is plastered on the cover of every magazine, but when a company is young, it's entrepreneurial, and it's just starting that explosive growth. And the answer, well, it might surprise you. It's not about buying low, it's about buying high.
I mean, listen to that. This idea comes from the trading legend Jesse Livermore all the way back in 1930, and it is completely counterintuitive. We're taught from day one to hunt for bargains, right? To buy the dips. But Livermore argued that a stock hitting a brand new high, especially a young stock, is actually a signal of immense strength. It's the market itself screaming at you that something powerful is happening under the surface.
So, how do we turn this powerful,
kind of crazy idea into a strategy we can actually use? Well, it all comes down to one specific chart pattern. Think of it as a launch pad that appears early in a company's life, right after it goes public.
And that pattern is called the primary base. You can think of it as a stock's first real test after it goes public. So once that initial IPO hype fades away, the stock pulls back a bit and just trades sideways for a few weeks, maybe even a few months. This consolidation, this pause, that's the base, and it forms right before the real move begins.
So why is this pattern so powerful? Well, because it's not just some random squiggles on a chart. This pause actually serves a critical function. It allows all the early IPO flippers and insiders to sell out and take their profits. And it proves that there's enough new demand, new buyers to absorb all of that selling pressure. This is all happening while the company is using its IPO cash to expand, its products are brand new, and its management team is at its most innovative and hungry. It's the perfect storm.
Now, theory is great and all, but let's see what this looks like in the real world. I mean, history is just littered with examples of legendary stocks that launched their massive runs from this exact pattern. So let's take a look at a few Hall of Famers.
Just look at this. This is Amazon, way back in 1997. It went public in May, had a nice little run-up, and then it settled into this sideways consolidation for a few months, from about June through August. That was its primary base. The trigger, the moment to pay attention, was the breakout to a new all-time high in early September. And what happened next? Well, it was truly staggering. From that single breakout point, over the next 16 months, Amazon stock just rocketed up 2,500%. Let that sink in. This simple, quiet little pattern was the launch pad for one of the greatest growth stories in market history.
And it wasn't a one-off. Here's another one from the same era, Yahoo. Now, at the time, internet providers was a brand new, totally unfamiliar industry. Most people just ignored it. But the chart was telling the real story. It formed this beautiful base, absorbed all those early sellers, and then in July 1997, boom, it broke out.
This right here is the power of getting in early. Over the next 29 months, Yahoo screamed an unbelievable 7,800% higher. I mean, by the time it was a household name, the biggest, easiest money had already been made by those who recognized that simple primary base.
And you know, a truly great stock doesn't just give you one chance. Take a look at Rambus. It went public at point A, formed its primary base, and then broke out at point B. But after that initial surge, it paused again, and it built a second base before breaking out all over again at point D. Each one of these consolidations is a brand new opportunity to buy a winning stock as it trends higher. And the result? A 1,450% gain. You see? These examples prove the primary base isn't a fluke, it's a recurring footprint. It's a signal that the big institutions are quietly moving into a young, dynamic company.
Okay, seeing those incredible gains is one thing. It gets the blood pumping, right? But how do you systematically find them before they happen? Well, that requires discipline and a really clear set of rules to separate the real setups from all the fakes. Look, not all consolidations are created equal, so here's the checklist. First, the base needs time to form, at least 3 to 5 weeks. You need that time to shake out the impatient investors. Second, the depth matters. For a pretty standard base, a pullback of 25 to 35% is normal. If it drops much more than that, it might be a sign of serious problems. And finally, the trigger, a breakout to a new all-time high on a huge surge in trading volume. That's the market giving you a crystal clear green light.
And this is exactly why those rules are so important. You might love a company's story. You might think their product is the future. But like Livermore said, your opinion is pretty much worthless until the market validates it. That breakout from a proper base, that is the validation you're looking for.
Okay, now we have to talk about the other side of the coin. Because let's be real, this is not a magic formula. Not every stock that breaks out becomes the next Amazon. Sometimes the pattern fails. And managing that risk, well, that's what separates successful investors from everybody else. Just look at the difference here. This slide says it all. On the left, you've got Amazon's clean, constructive, orderly base where the selling was contained. On the right is Facebook right after its IPO. Now that's not a consolidation, it's a collapse. A 43% drop in just a few weeks is destructive price action, not a healthy pause. It never formed a proper base, which made it completely unbuyable at the time. And here's an even more dangerous scenario, a breakout that just completely fails. iRobot emerged from what looked like a perfectly valid primary base, but the breakout had zero follow-through. It immediately rolled over and started selling off. If you bought that breakout, you had to have a plan to get out fast. The stock went on to lose 65%. This is exactly why you must always have a stop loss. Cut your losses quickly and just move on.
So we know how to spot the pattern and we know how to manage the risk. How do we apply this whole mindset to the future? Well, it starts by stop looking in the rear-view mirror.
Here's another gem from Livermore. He reminds us that markets are dynamic. They're always changing. The dominant companies of one cycle are rarely the dominant companies of the next one. Leadership rotates. Our job is not to cling to the old leaders, but to find the new ones.
I mean, look at the life cycle of a market leader. Circuit City was an absolute monster in the 80s and 90s, a true innovator. From 1981 to 2000, the stock went up over 63,000%. It was an institutional favorite, a must-own growth stock. But then it got big, it made mistakes, and that explosive growth phase ended. By 2008, the company was bankrupt. The stock was worthless. The innovator became a relic.
And that really brings us to the final thought, doesn't it? The companies everyone is talking about today, the market's darlings, the institutional favorites, they've already had their best growth. Their story is already known. The real opportunity lies in doing the detective work, in searching for those young entrepreneurial companies that are quietly building their primary base, just waiting for the market to discover them. The real question is, will you be there to find them?
You know, in any competitive field, whether it's sports or business, we always celebrate the champions, right? But what really separates the people who win consistently from the ones who just get lucky once, it's not just about scoring points or making these spectacular gains. It's about defense. So today, we're going to dive into the single most important and yet, honestly, the most overlooked part of success, managing risk. And to really get this, we're going to the ultimate proving ground, the U.S. Investing Championship. This thing started back in 1983, and believe me, it was not some stuffy academic exercise. This was a real money, knockdown, drag-out fight where some legendary traders were made. You can basically think of it as the Super Bowl for the stock market. And right in the middle of this high-stakes world, we're going to follow the story of one trader. This guy faced a setback that, well, it would have made most people just pack it in and go home. But his story reveals the true secret to winning not just a competition, but the entire game. Okay, so get this. The journey is just pure drama. In 1996, he's on fire, up over 190%. They're telling him he's way in the lead. Then bam, the whole contest gets suspended. A year goes by, and it's back on. But his incredible performance, gone. Wiped clean. He has to start all over from zero. And this time, he's up against traders using massive leverage, trading with tons of borrowed money to supercharge their returns and their losses. So what happens? He sticks to his game plan and wins, putting up an incredible 155% return.
So that really brings us to the big question, right? How in the world did he pull this off? It wasn't by taking some crazy risks or trying to make up for lost time. He didn't just throw his strategy out the window when he fell behind. No, the secret was something way more fundamental.
And the answer is, well, it's surprisingly simple, but it is incredibly hard to actually do. It all came down to two things: an unwavering commitment to his plan and, this is the big one, super tight risk management. He knew that defense, not just a flashy offense, is what wins championships in the long run.
And look, this isn't just some feel-good story. This whole principle is rooted in cold, hard, unforgiving math. And understanding this math is the absolute first step to protecting your capital and really getting why defense wins.
So, take a look at this table. It shows you the gain you need just to get back to where you started after you take a loss. A little 10% loss? Okay, you need an 11% gain to recover. That's manageable. But as that loss gets bigger, the gain you need to recover doesn't just grow, it grows exponentially. It gets out of hand fast.
And here it is, the most shocking example on the whole chart. If your account drops by 50%, you don't need a 50% gain to get back to where you were. No, you need to double your money 100% gain just to break even. That is the brutal, brutal math of negative compounding.
So here's the key takeaway. It's not just about losing money, it's about losing your buying power. It's about digging yourself into a hole that gets exponentially harder to climb out of. Letting a small mistake turn into a huge loss is one of the most destructive things you can possibly do to your capital.
Now, this slide right here, this is where theory becomes undeniable proof. I mean, really take a second and look at this, because it's a total game changer.
So the author did an exercise on his own trading history. On the left, you see his actual results from 20 trades. You see the mix, right? Some fantastic wins, but also some pretty big losses, like that minus 43% one. Ouch. The final result? He was down 12%. Now, look to the right. He reran the exact same sequence of trades with one single hypothetical change. He capped every single loss at 10%. That's it. The winning trades, they all stayed the same. And the result? That 12% loss got transformed into a nearly 80% gain. One simple defensive rule changed everything.
So if the math is so clear and the evidence is so powerful, why do so many of us fail at this? Well, the answer isn't in our spreadsheets, it's in our heads. Let's dig into the psychology that's constantly working against us.
You know, economists actually have a name for our biggest mental flaw. It's called the disposition effect. In plain English, it just means we are hardwired to sell our winners way too early because it feels good to lock in a profit, while we hold on to our losers for far too long, just hoping they'll come back. We're basically choosing to have a portfolio of small wins and really big losses.
And this isn't just some theory. A massive study of over 77,000 brokers' accounts confirmed it. People consistently hold their losing stocks, they often even double down on them, and they are way quicker to sell something for a small gain than to just take a small, disciplined loss. It's a behavioral trap that we all can fall into.
This whole thing creates a kind of split personality, doesn't it? When a trade is working, we act like a short-term trader, cashing in our chips real quick. But the minute that same trade goes against us, we start to rationalize. We tell ourselves, oh, I'm not a trader on this one anymore. Now I'm a long-term investor. We become what the legendary Jesse Livermore called an involuntary investor. Basically someone who's stuck in a bad position because their ego just won't let them admit they made a mistake.
And here's another mental trap. Thinking of your profits as house money. You know, you make $5,000 on a trade, and suddenly it feels like you're playing with the casino's money. You can be a little more reckless with it, but you're not. It is your money. Yesterday's profit is part of today's principal, and you have to protect it with the exact same discipline and the exact same rules.
So how do we actually internalize these lessons and fight our own worst instincts? Let's look at a few powerful analogies that can really help frame the right mindset for survival and, ultimately, for success.
The author tells this great story from his karate days. He could do all the flashy, movie-style flips, right? But one day, his instructor just kicked his leg out from under him while he was in a basic stance and sent him straight to the floor. The lesson? You have to master the fundamentals. Risk management? That's your basic stance. Without it, all the fancy offensive moves in the world are completely useless.
Think about a professional poker player. They don't play every single hand. They will happily fold 30, 40, 50 hands in a row, taking tiny, predictable losses on the ante. Why do they do that? Because they're waiting for a high probability situation where the potential reward is just massive compared to the risk. A stock trader holding on to a big loser is doing the exact opposite, taking a huge, unknown risk on a low probability hope.
But here's the beautiful part. In the stock market, you have an advantage that even a poker pro dreams of. It costs you absolutely nothing to wait on the sidelines. You can sit in cash, watch the market, and just wait for that perfect moment when the probabilities are stacked in your favor. You get to see the cards for free before you place your bet. It's an incredible edge that most people just throw away because they're impatient. And all of this brings us to the final and probably the most important takeaway. It's a simple little distinction, but it's really at the heart of what separates mediocrity from greatness in any speculative field.
This quote from Dan Sullivan it absolutely nails it. You are going to make mistakes. You will be wrong about trades. That is unavoidable. It's just part of the game. The real failure, the mistake that truly costs you, is refusing to accept that you're wrong and do something about it. Which leads us to this final, really crucial question you have to ask yourself. What's your actual goal here? Is it to make money, or is it to prove that your original idea was right? See, your ego desperately wants to be right. But your account, it just wants to grow. You really can't serve both masters.
So the ultimate lesson is this. Cutting a loss won't guarantee you'll win the next trade, but it absolutely will guarantee your survival. You can't control how high a stock is going to go, but you can, in almost every case, control how much you're willing to lose. Everybody makes mistakes, but staying wrong, that is always a choice.
So you want to know the secret to winning in the stock market, and maybe more importantly, how to actually keep what you win? You know, through all the ups and downs, the thing that separates the pros from everyone else it isn't some magic formula. It really boils down to just one thing: mastering risk management. You know, the legendary trader Larry Hite just nailed it with this one. This quote is pretty much the foundation for everything we're about to talk about. Yeah, of course, you have to be in the game to win. But rule number 2 is the one that really matters. If you lose all your chips, it's game over. Survival comes first, always. It sounds so simple, but it's absolutely profound. So, keeping that idea in mind, I've got a question for you. Does this scenario sound just a little too familiar? Oh man, we've all been there, right? You buy a stock, feeling great about it. Then it dips a little, and you tell yourself, it's fine, I'll just sell when it bounces back. But that bounce never really comes, does it? It just keeps sinking. And with every new leg down, you're just kicking yourself, wishing you had sold earlier. That feeling of being totally frozen, just paralyzed by regret, that's exactly what we're here to put an end to. All right, so here's our game plan for this explainer. We're going to start by digging into the core problem. Then we'll flip the script to the professional's mindset. From there, we'll build a concrete plan, look at the cold, hard math behind it all, cover some killer tactics and the traps to avoid, and we'll wrap up by showing you the incredible, kind of unfair advantage you have right now. So first up, the investor's dilemma. Let's really get to the bottom of why so many people struggle in the market. You know, here's a fundamental truth that might surprise you. Most people think it's the big scary bear markets or a bad economy that wipes them out. But that's not it. The biggest enemy you'll ever face in the market is looking at you in the mirror. It's these mental hazards, it's your own ego, your hope, your fear that stop you from taking a tiny, manageable loss before it spirals into a catastrophic one. Okay, so if the biggest problem is in our own heads, it makes sense that the solution is too. And that brings us right to the professional's mindset, which is really all about one single principle of greatness. It really comes down to a choice between two paths. You can be the thrill-seeking gambler, riding that emotional roller coaster of highs and lows until you're exhausted and broke. Or you can be the bored, rich trader. Because here's the thing, good professional trading isn't an adrenaline rush. It's methodical, it's disciplined, and honestly, it's often kind of boring. But that's the mindset that gets you consistent results. So you're probably asking, okay, great, how do I actually become that disciplined, bored trader? Well, the answer is you need a plan. Not just any plan, a trading flight plan where you're prepared for every single possibility before it even happens. I absolutely love this analogy. Think about an airline pilot. They don't just jump in the cockpit, cross their fingers, and hope for a smooth flight, right? No way. They have a checklist and a pre-planned procedure for literally everything that could go wrong. When an alarm goes off, there's no panic, no debate, no emotion. They just execute the plan. Your portfolio, your money, deserves that exact same level of professional preparation. And this flight plan has 4 absolutely crucial parts. Number 1, your initial stop loss. That's your non-negotiable exit price before you even click buy. 2, a re-entry plan. Sometimes a great stock will shake you out and then set up again. You need a plan for that. 3, a profit-taking strategy. And number 4, the disaster plan. This is for the really crazy out-of-the-blue stuff that rocks the entire market. Okay, let's talk about the math of survival. And don't worry, you don't need to be a math whiz for this. The big takeaway is that trading isn't about having a crystal ball. It's just about playing a game of probabilities where you have a mathematical edge. Okay, check this out. This is so powerful. Let's just focus on being right only half the time, a 50-50 shot, basically a coin flip. If you can make your average winning trade twice as big as your average losing trade, that simple 2-to-1 ratio, look at that return. It's massive. This proves you don't need to be perfect. You just have to be incredibly disciplined about making more on your winners than you give back on your losers. Now, this next chart shows something that kind of breaks your brain at first. We're always told more risk, more reward, right? Well, that's not always true. See, there's a sweet spot, an optimal ratio. Notice how the return goes up, hits a peak, and then actually starts to fall? If you risk too much on any single trade, you start making less money, even if your win rate stays the same. It's wild, but the math doesn't lie. So all of this math leads us to one single, unbreakable rule: the trader's cardinal sin. This is the one thing you absolutely positively cannot do. Let any single loss get bigger than your average winning trade. The second you break this rule, the math is stacked against you. it's pretty much game over in the long run. Okay, so we've got the mindset, the plan, and the math. Now let's get into the nitty-gritty. What do the pros actually do day to day, and what are the common traps that everyone else falls right into? Here's another perfect analogy. An ER doctor. When a patient gets wheeled in, what's their first job? It's not some complex diagnosis. It's to stop the bleeding, period. And in trading, your portfolio is the patient. Your first job is to stop the bleeding, to stop the loss. Why? Because the math of recovery is brutal. If you lose 50% of your money, you need to make 100% on what's left just to get back to even. That's a huge mountain to climb. There's this old saying on Wall Street, and man, is it true. Your first loss is your best loss. Just let that sink in for a second. Taking a small, planned loss is an act of discipline. Letting it turn into a huge, unplanned loss is an act of devastation. That first cut is always the cheapest, best lesson the market will ever teach you. And this right here is maybe the biggest behavioral difference between pros and amateurs. What do the pros do? They feed their winners. If a stock is working, they add more to it. And what does everyone else do? They feed their losers. They keep adding more money to a losing position, a terrible habit called averaging down. It's basically throwing good money after bad. I know this sounds harsh, but you need to hear it. Only losers average losers. Think about it. The market is literally screaming at you. You made a mistake on this one. And averaging down is like plugging your ears and yelling back, "No, I'm right," while you throw more money into the fire. It's a self-destructive habit you have to break, like yesterday. Okay, let's wrap this up by talking about your unfair advantage. Because seriously, right now is the best time in history to be an individual investor. This isn't some impossible obstacle course. It's an environment that's totally primed for your success. Can you even imagine what it was like for the old-timers? They had to draw their charts by hand, with a pencil and paper, getting prices from the next day's newspaper. Commissions were over $100 a trade. But today, you have the equivalent of an F-16 fighter jet on your desk. Real-time data, instant execution, powerful charting tools. The playing field has never, ever been this level. And listen to this. The author of our source material, he dropped out of school at 15, started with basically zero money, no formal education, and his point is so powerful. Look, if I could figure this out back then with every possible disadvantage, just imagine what you can do today with all the tools and information you have. It's incredibly empowering. So look, here's the bottom line. The strategy is here. The math is clear. The tactics are laid out for you. You have the flight plan. You have the F-16. In today's world, knowledge isn't the barrier anymore. Access isn't the barrier. It all comes down to one final question, and only you can answer it. Do you have the discipline to actually execute the plan?